right, I guess we can get started. Thank you all for being here. Of course, it is a true honor today to have Chair Jay Powell and former Chair and Nobel laureate Ben Bernanke with us today. Thank you very much for being here. I've very much been looking forward to this conversation. I'm sure our audience has too, so let's just get to it. This conference, as everyone knows, is dedicated to the memory of Thomas Laubach. And earlier this morning, we heard some personal reflections on working with Thomas from Secretary Janet Yellen, also former chair of the Fed, and from President John Williams. And both of you worked closely with Thomas as well. So I'd like to give you both an opportunity to share your own thoughts about Thomas's contributions as an economist, as a central banker, as a colleague. Ben, maybe we can start with you.
Sure, and it's great to be here. I was Thomas's thesis advisor, and he worked with me on a book on inflation targeting when he was still a graduate student. And that was a long time ago, and he was not yet in his exalted position at the Fed when I was doing Jay's job. So I don't have any short little anecdotes to give, but I do want to say that I think there are sort of two kinds of accomplishments a person can have. They can have curriculum vitae accomplishments, and they can have what I call eulogy accomplishments. Curriculum vitae accomplishments are things like published papers and promotions and awards and recognition. Eulogy accomplishments are the things your family remembers. You know, your kindness, your support.
What is going on, guys? I don't know what the hell they're talking about now. They're giving some sort of eulogy to some dead economist. God rest his soul. What is going on, guys? I'm going to take the opportunity to say what's up to you guys, and also post this on Twitter. So 1 second, but hope you guys are doing well. Kind of a slow morning trading wise. Not only is it because it's Friday, but obviously because people are waiting for Jerome Powell's speech. It's also OPEX, right? So it's options expiration for the month. But I promise you, as soon as they start talking about something poignant, we will switch back to this. By the way, if you guys can't hear me, let me know. If you can hear me, then you don't need to say anything. But let me just... I'm trying to tweet this out. 1 second. But yeah, I hope you guys are doing really, really well this morning. I kind of... It's not a strict point, but I kind of said that I would trade less on Fridays only because the volatility, wasn't really, I don't know. Like I felt like on Fridays lately, it was just me staring at the screen for 8 hours, not really taking any lucrative trades. But, we'll see if there are some setups here. Currently, I'm looking at Netflix. I sent this out in the Academy as well. Waiting for this level to break here. I was considering and tempted to short at the GP and this imbalance here, but I didn't. So just monitoring this for now, waiting to see what Jerome Powell has to say. Let's see whether he's talking about the markets.
Immediately evident. He was very gracious to me, and we had
still talking about this guy that passed away. Join us for live trading, charting, and Jerome Powell. Sorry, I'm just tweeting this out. Cool. Let's see. Are there any pre-questions? Let me say what's up to some of you guys. Gary, Gashi, Manu, Sonar, what's going on, guys? El Kukui, what's going on? Richard Harrington, what's going on? Marianne, Sherm Dog, N Martinez, Joe, what's going on, bro? Low Key the Great, what do you think about AI the ticker? I don't know. Volume up? You mean on me? You guys can't hear me as well? Let me know if you're talking about me or you're talking about Jerome Powell, because I have him on mute because they're not even talking about policy right now. What's going on, Chef? Tyler, what's going on? Richard. Guys, if you're on here, hit that thumbs up. If you can hear me loud and clear, great. If you want me to turn up the volume of this mic, let me know. Okay, cool. Thank you, Alia. yeah, right now they're just shooting the shit. But here are some things that I'm looking at this morning, wanting to see Netflix. Actually, you know what? Let me send this out here too. Hold on. Oh my God, where's the okay? Live. No. Everyone. Fuck. Why does Discord do this? There you go. Oh my God. I'm messing this up. Live now at everyone. Oh my God. Why is it doing this? Yeah, I know this is fun. You guys watch me do this. Okay, you know what? Fuck this. Why is it? Live? No. Okay. I don't know what is going on with Discord. All right. Let us check out what Jay Pitty is saying.
Restore and sustain price stability.
Here we go.
So today, while inflation isn't as high as it was when I was in college, it's nonetheless far above our 2% objective, and many people are currently experiencing high inflation for the first time in their lives. It's not a headline to say that they really don't like it. So we are very aware that high inflation imposes significant hardship as it reduces purchasing power, especially for those who are at the margins of the economy and living paycheck to paycheck and need to use all of their incoming income to pay for food, housing, and transportation and other essentials. And that's why the committee is so strongly committed to returning to our 2% goal. We think that failure to get inflation down would not only prolong the pain, but also increase, ultimately, the social costs of getting back to price stability, causing even greater harm to families and businesses. And we aim to avoid that by remaining steadfast in pursuit of our goals.
Thank you. Ben.
Well, I had mentors, Dale Jorgensen at Harvard and Stanley Fisher at MIT in particular, but I'm going to tell you about something that happened to me when I was 6 years old. I used to visit my grandparents in Charlotte.
Bro, nobody gives a fuck about what happened to you when you were 6.
Their house and listen to my grandmother tell stories about her life. And she told about how she raised her family in Connecticut in the 1930s during the Great Depression. And it was a town that was specializing in shoe manufacture, and during the Depression, a lot of the factories were shut down. And she told me that, it was a very hard time. A lot of the kids went to school in tattered shoes or maybe no shoes at all. And I said, Grandma, why would they do that? And she said, well, because their fathers lost their jobs. Why did they lose their jobs? Because the shoe factory shut down. Now, I was only 6 years old, but I could see the problem with that argument. I said, well, why didn't they just open the shoe factories and make shoes for the children? And she said, it doesn't work that way. But I think it really was a puzzle to me that you had the same productive capacity in 1933 that you had in 1928. And in 1928, people were dancing to Charleston, and in 1933, they were in bread lines. And that really impressed on me, that economics can make really big difference in people's lives. And monetary policy is like that. I mean, it's, as Jay, of course, and all of you well know, that the decisions made in this building have a very broad and real effect on people's lives. And for that reason, besides its intellectual fascination, it's worth studying and understanding.
Yeah. Thank you. I know that's certainly a key motivation for many people in this room to be working so hard. Okay, let's now turn to some topics of more current interest. And I'd like to start with the nexus between the financial system and the macroeconomy. Both of you, during your 10 years as chair, have faced very significant historic financial crises. Ben, obviously you confronted the global financial crisis, and Jay, the global pandemic. Those episodes were clearly acute, very vivid examples of the connections between the macroeconomy and the financial system, as well as, I think, a good illustration of the role of central banks in such episodes. But Ben, your research, importantly, and the research that you have inspired, has really demonstrated that understanding the connections between the financial sector, credit markets, and banks and the real economy is critical for even understanding traditional business cycles. So with that as background, we have just experienced a period of stress in certain parts of the banking system here in the United States. So I want to get your take on those developments, how you think they match up compared to some previous episodes, and what they might mean for the economy.
Well, in some dimension, the recent crisis has followed the standard sequence. I don't know anything about Silicon Valley Bank other than what I read in the paper, so please don't misinterpret this. But it was a classic situation where they had assets that were subject to risk. In particular, as interest rates rose, the value of their long-term assets fell and their capital fell. They had hoped to hedge that by their deposit franchise, where as interest rates rose and interest rates moved more slowly on deposits, that would partially compensate, but they were dealing with customers who were very social media savvy, and that didn't really work. So after the decline in capital, you had the second stage, which is runs, people taking out their money, which ultimately led to the collapse of the bank, despite, I may add, good efforts of the Fed and the FDIC to provide liquidity and provide support for depositors. The third stage of a banking crisis is contagion, and people looked at other banks and said, oh, they look sort of vaguely like Silicon Valley Bank. They got the same number of letters in their name and all kinds of things like that, and that caused people to begin to remove, deposits elsewhere. And finally, the reason this is important is that it ultimately affects credit conditions. And the Federal Reserve is, of course, looking at the effects of bank problems and other financial issues on the extension of credit and therefore on the real economy. So, in that respect, I think it's very similar to other crises. I think it's different from the global financial crisis in many ways, including its scale and scope, of course, but I would mention a couple of things, a couple of important differences. One is that the impaired asset in this case was U.S. Treasuries, which are very different assets in kind from subprime mortgages, in that U.S. Treasuries can always be valued accurately, and so there's not the uncertainty that was associated with subprime mortgages. And secondly, as the economy declines, if it does decline, U.S. Treasuries actually become more valuable rather than less valuable, and so there's kind of a counter-cyclical effect. So that's one very important difference, I think. And then the other worth mentioning, but very important, is that relative to, say, the GFC or the Great Depression, overall, borrowers are in much better shape, than they were in these previous episodes. And that makes a big difference, both in terms of the stability of the banks and also in terms of the impact on consumer spending and the economy in general.
Well, I guess a major reason that situation didn't get worse, and I think the contagion was very much contained, were the forceful actions, Jay, that you and the Federal Reserve took through the use of your liquidity tools, including the creation of the Bank Term Funding Program. However, in deploying these liquidity tools, that has come at, against this backdrop where the preeminent monetary policy concern is high inflation. And that's, of course, a little different from some of the earlier episodes, and has raised renewed discussions about the so-called separation principle, right? And so I wanted to ask you how you think about the use of financial stability tools and liquidity tools as opposed to more traditional monetary policy tools and how they fit together.
It's an interesting question, but I want to start by saying, though, that the overall, the banks and the banking system are strong and resilient and well positioned to deal with the challenges they may face now or in the future. So, as you pointed out, we do have separate tools: monetary policy to achieve our macroeconomic objectives, liquidity, supervisory, and regulatory tools to address financial stability issues. But I see an important distinction between separation, this is the separation principle, separation and independence. Our tools can have separate objectives, but their effects are often not entirely independent. So the tools are complementary almost all of the time because financial and macroeconomic stability are so deeply intertwined. In fact, our consensus statement notes that sustainably achieving maximum employment and price stability depends on a stable financial system. So because they're so intertwined, to me, there is not likely to be an absolute and complete separation of the tools, nor is that possible or desirable. And I think as Ben's research and the global financial crisis demonstrated, financial stability affects macroeconomic stability and vice versa. We saw that clearly at the outset of the pandemic. As a result, the tools that we use to address concerns in either arena can and will affect both, especially during extreme circumstances. That said, yes, the tools are separate, they have individual purposes, and most of the time each can be used for its intended purpose without compromising the other. For example, as you pointed out, when banking stresses emerged in early March, we used our liquidity tools, the discount window and the Bank Term Funding Program, to make liquidity available to banks that might need it. And that liquidity supported the stability of the financial system without restricting the use of our monetary policy tools to promote price stability. While the financial stability tools help to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So as a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain. So.
Okay, thank you. And of course, I think the effectiveness of those tools is reflected in the fact that the FOMC
Clearly, the market
has
is reacting to
raised
this.
interest rates twice since
you see
the
this huge
emergence of the
liquidity
banking
wave.
constraints. Of course, the purpose of that is to confront the inflation issue, which brings us to our next topic, which is in fact inflation. In the pandemic and the aftermath, we've had many renewed discussions of the important and classic textbook distinction between supply shocks and demand shocks, and in particular the particular challenges that a supply shock can present to a central bank. And that's also raised a lot of questions in academia and in policy circles as to whether or not the inflation process post-pandemic is going to look quite different than prior. Jay, maybe we can start with you. A number of folks have argued that we are entering a new period where supply shocks will be more frequent. Would love to hear your views on whether you think that's a possibility and what that might mean for central banks.
So it's a great question, and it's one I think we'll be dealing with for quite a long time. And I'd say it's certainly possible that we'll see continued supply shocks. I also think it's just very hard to forecast that with any confidence. As Yogi Berra is thought to have said, Ben, you're the baseball expert, you can confirm or deny this, but it is difficult to make predictions, especially about the future. So I think that the best we can do at this stage is probably to just identify the factors that we think can lead to further negative supply shocks. I will say that, though, that positive supply shocks related to globalization largely probably contributed significantly to the period of low inflation that either ended or was interrupted by the onset of the pandemic. And I'm thinking there of the vast increase in global labor supply, the development of efficient global supply chains, facilitated by technological advances and things like that. And I would say those positive supply shocks do not seem likely to be repeated. At the same time, the drivers of the current inflationary surge certainly included a sequence of large negative supply shocks to the global supply chain for goods, which also experienced a large and persistent shift in demand from services to goods, and also the supply of workers. On top of that, Russia's war against Ukraine brought further shocks to global supply chains, particularly supplies of energy and non-energy commodities. So we can't know how persistent those shocks will be or whether further negative supply shocks will come along. Will globalization be partially or fully halted or reversed? Will it resume again as the pandemic mercifully recedes into memory? We can't really know that now. But for policymakers, the bottom line is that central banks will continue to be responsible for providing price stability, and that will require us to navigate whatever additional supply shocks do occur. So as Tomas and Ben and their co-authors wrote in the inflation targeting book, what a central bank can do is control inflation. And that is true over time, even in the presence of supply shocks, should they come.
Ben, we'd love to hear your views on this.
So unusual events which disrupt normal economic functioning often are followed by inflation. Examples are World War I, World War II, the Korean War, and now the pandemic. And the pandemic just makes it harder for policymakers to understand what's happening and to react appropriately. And in particular,
I hope the interviewer asks them specifically about the balance sheet, right? Like the Fed balance sheet, the money printing, et cetera. Really, this is all just very surface level information in my view, right? They're talking about inflation. Obviously, the Fed can only control interest rates. They can't really control the supply side. They can only affect the demand side or try to affect the demand side. So it's, it seems very, very surface level info. In terms of how the market is reacting, let's take a look. I mean, clearly the market was waiting for Jerome Powell to speak. And right now you're seeing insane liquidity wicks to the downside. The market is likely going to, teeter around, I think, this flat area until they're probably done, until they realize that, Jerome Powell is not going to say anything new or revolutionary. 2% is the goal. Inflation is hard to fight, yada, yada, yada. We're going to do whatever we can. We're going to, wait for the data, et cetera. It is super interesting. I was seeing here, I posted this in the Academy this morning, but if you look a week ago, there was only a 15% chance that the Fed would raise. However, now it's up to 36.5% chance that the Fed is going to raise in June. Now, the reasons for this are a couple of things. One, obviously, the markets, if you take a look at the broader market, the market is now hitting that 4,200 resistance level that we mentioned time and time again. The market is really has been between this 3,800 and 4,200 level since going all the way back to last May. So exactly a year now. We popped a little bit above when inflation peaked. We popped a little bit below at the current bottom of this bear market, but really between 3,800 and 4,800 is the level that the S&P has been trading at for a year, right? So everyone was talking about a potential lost decade or a long period of sideways trading. That already started in May. And this is why I was saying in my videos that there is a ton of uncertainty here because there is no clear direction for me. Like, I don't see a huge reason to be bullish. I don't see a huge reason to be bearish. I think that the good news and the bad news are sort of equally weighed. Inflation is coming down, and it's coming down rapidly. We also have PPI that front runs CPI, right? And we know that PPI came in way cooler than expected the last readout. And if PPI has always led CPI, that means that CPI is likely to come down as well. So, with that said, you have cooling down inflation. Unemployment is still historically low, but you also have the fact that inflation CPI itself remains at around 5%. You have all of the yield curves inverted. You have bond yields going crazy. So there are really conflicting data points now that to me don't really, and obviously the debt ceiling standoff, that don't really signal a clear direction. Now, I did say yesterday in the Academy when I posted some analysis, I was saying that I do think that solving the debt ceiling will take us back to this 4,300 level, around there. And then if the Fed actually pauses, then we could even get to the 4,500 level on the S&P 500. That is my thesis. If the debt ceiling standoff is pushed out way too late, like it was in 2011 when the S&P 500 saw a 20% drop just from the debt ceiling standoff, if they push it way to the brink and then the U.S. debt is actually downgraded once again, like it was in 2011, yeah, then I could see us push down to that 3,800 level, possibly maybe a little bit below that. But I think the debt ceiling will be solved. They do have a deadline of June 1st. So, yeah, I don't really see a reason to be ultra bullish or ultra bearish. And I do think that options premiums in both ways are getting killed, right? Like, don't think call buyers. If you were a call buyer for a month and a half, you were getting killed, right? This is the range that the S&P was trading for a month and a half. right? Calls and puts both got killed, unless you're day trading. Obviously, I'm talking about, multi-day positions. I'm not talking about what you enter in a day and exit in a day. I'm talking about if you just bought calls or puts and just held it, your options premiums are getting killed in both directions, right? So, we are at the pivotal 4,200 level. I don't expect there to be a huge rally from here until we get word on the debt ceiling. And by the way, this 3-day rally that we saw from 4,100 to 4,200 on the S&P 500, that was all due to the fact on Tuesday that the White House came out and said that even though we're far apart in terms of coming to a deal, we think a deal can be struck as early as next week, and we have made progress, right? So that enthusiasm is really what caused this little 3-day rally from 4,100 to 4,200. That's what caused bond yields to spike. If you take a look at bond yields right now, and this was one of the losing positions that I had recently, was on the 2-year futures. I actually got stopped out on a trade. It's still near support, but I was stopped out because I wasn't willing to let it bleed further than this support level at 102.25. I am looking to get back in this position, especially as we are hitting this weekly imbalance. But that enthusiasm is what caused bond yields to sharply rise, because if bond investors are enthusiastic about the progress of the debt ceiling talks, then they're not really. Oh, you know what? I just realized I'm wearing a green hat. What the fluck? I'm just wearing. That's why it looks crazy like this. What a dumb choice. But if bond investors are, if they're enthusiastic about the market, then they're going to, pour money more into the stock market than into bonds, which is going to cause bond yields to rise. That's why bond yields have been going up within the last couple of weeks, right? Because of the enthusiasm around solving the debt crisis. Let me go back to this and see what they're saying. Hold on.
Both with an eye toward making policy more effective, but also for the purposes of promoting transparency and accountability. Ben, you've obviously played a critical role here, advancing the FOMC's communications, including the introduction of press conferences after FOMC meetings, the introduction of the summary of economic projections. So what changes over this period since the communication, say, revolution began, would you highlight as being some of the most effective, most important, and where do some remaining challenges exist?
Well, let me talk about communication, because I think you need to understand that it serves multiple purposes. I mean, one of its purposes.
Guys, if you're on this live stream, I see almost 1,000 of you. Hit that thumbs up, guys. Hit that thumbs up. There's only 150 likes. Hit that thumbs up.
Span. You go back to 1994, the first FOMC statement. I mean, since then, the Fed has tried at least to give some indication of what it's thinking and what it sees as the risks to the economy. But beyond that, you mentioned transparency and accountability. This is a powerful institution. It's very important that it be accountable to the Congress and to the public, and best way to do that is explain what we think, what we're doing, and how we're going to go about that. There's other reasons for communication. One I would talk about is feedback. We're having a conference here. If the Fed puts out the issues that it's concerned about, economists will write articles or tweet and respond to that. Or in the case of the Fed Listens program, maybe it would be more ordinary people who are explaining, how monetary policy affects them. One final thing I would mention is diversity of views. Because the Fed has a consensus culture, and there are very few dissents normally, the outside perception is the Fed is subject to groupthink, which of course is possible, but with people talking about, their own views and explaining why they see the economy as they do, it does, I think, at least to some extent, show that there is a range of opinion on the committee. In terms of tools, I guess I do feel proud about the press conferences, which I introduced 4 times a year after the summary of economic projections, in which Chair Powell has taken to an art form. And I think also, just the inflation target, the forecasts that we release, and there's a cultural change, which some people don't like, but I think on net is good, which is, it used to be, if you look back at speeches in the Greenspan era, the president of the Federal Reserve Bank of Minneapolis, would talk about, harvests or something, wouldn't talk very much about the global or national economy. Now you have a lot of people talking about, the different aspects of the Federal Reserve's views. And again, that contributes to both market transparency and also to accountability to the local constituency and to the national constituency.
Jay, you, of course, have continued to push forward on the communications and transparency fronts. Welcome.
So you guys in the chat are telling me the debt ceiling talks just got stalled. Do you guys have links for this? I'm looking this up. Do you guys have links for this? Let me know. We're seeing now the rejection. I mean, it's crazy when, right? Like, people try to dismiss technical analysis or fundamental analysis or whatever. It's crazy that they're always both working in line, right? Like, we're at this 4,200 level, right? What if the debt ceiling talks stall right now and we get a rejection from this, right? You can't say that the 4,200 level is not a real level. It's been resistance for a year now. It's crazy when people dismiss one or the other. Let's see, CNBC. Okay, let's go live to CNBC. These guys are putting me to sleep. Let me see. CNBC. All right, let's go to CNBC, guys. Thank you.
Time where you would expect him to comment in depth about the status of the debt ceiling. They've made any progress. Certainly the expectation was that negotiators were going to keep talking throughout the weekend. And certainly, all of next week is long. They have, several days that they could continue meeting. But I think, Carl, the clock is ticking. And if there is not an agreement soon, then I think the market may have its own say about what needs to happen here.
A lot going on right now. There was also a headline crossing. Yellen told bank CEOs that more mergers may be necessary. That was according to CNN. But very sensitive here around some of the headlines, all talking as the Fed chair is talking, Kayla. We saw the banks, the KRE, the Regional Bank Index, which we watch as a litmus paper, turn negative on the day after those Yellen headlines. Not sure if you know any more about just what was said between Yellen and the CEOs.
Well, I know that the discussion was around regulation. This is a regularly scheduled meeting by the board of the Bank Policy Institute. It happens every year. And so, they have a broad discussion about the state of the industry. And it's only natural that recent consolidation, recent emergency measures, and forthcoming changes to regulation would have been on the agenda for those discussions. When I talked to people who are inside the room, they said that, they were talking more about the health of the economy. And I'm also told that Secretary Yellen reaffirmed the June 1st X date, that there was no additional wiggle room privately behind the scenes when talking about any potential flexibility that Treasury may have to pay its bills or prioritize its bills if these talks didn't have progress. So certainly there was a conversation and would have been a conversation about regulation, about the banking industry writ large, but also very big concerns from these companies who essentially, keep the Treasury market moving about what exactly is going to happen in the next few weeks.
Kayla Tausche. Kayla, thank you very much for the update, of course, on the breakdown in those debt ceiling negotiations. A lot hitting the market right now. And, of course, bank consolidation, if there's more of it, means, we're reminded that more banks might fail. There might be more stress in the system. So a little sensitive. As far as the Powell remarks so far, Carl, not much. He did make one remark about the developments in the banking sector, which he said may mean that the policy rate, our interest rate, might not need to rise as much to achieve the policy goals. I guess that's dovish, although he said some similar things before.
Yeah, that was maybe, I don't know, if you're dovish, one of the more constructive headlines we got in the last 30 minutes. I was struck by the number of times they talked about supply shocks, given the fact that supply chain pressure indices are actually back to levels we last saw around the time of Lehman.
Yes.
I mean, you can ship a good around the world pretty easily now, and it was interesting that that continues to rise to on their radar.
Right. They should be talking about the other shocks of inflation right now. But it's a very academic conference. Chair Powell seems very prepped. He has notes.
All right. So, yeah, let me know if you guys have any questions or anything you want me to chart. But basically, the conclusion is from the Chair Powell discussions, nothing revolutionary, nothing that you guys haven't heard before. What is tanking the market right now, at least the S&P 500. Let's check on the other indices real quick. S&P down 0.26, NASDAQ down 0.33, Dow Jones down 0.37. VIX is up 3%. Nothing too crazy. What's tanking the market, obviously, is the fact that we're at the psychological 4,200 level. But also, in conjunction with that, right? Like when news and technicals merge, you have the perfect storm for a reaction. But we just got word that the GOP has stalled on debt ceiling talks, and apparently they walked out of the talks. Now, this is a fucking circus, guys. Like, it's crazy how this happens every single time, right? We're the only developed country in the world that has a debt ceiling. Canada doesn't have a debt ceiling. The UK doesn't have a debt ceiling. Japan doesn't have a debt ceiling. Italy, France, China, you name it, right? Denmark actually has a debt ceiling, but Denmark's debt ceiling is actually a real debt ceiling, meaning, you know, why do you have a debt ceiling if you just set it to slightly above the limit that you're at currently, and you use then that you know you're going to hit it very soon, and then use the debt ceiling as a political football or chess piece, right? Take your pick of the analogy, where Denmark actually has a debt ceiling, but their debt ceiling is so high that, you know, if they hit it, it would mean that there is a critical malfunctioning in their debt issuance, right? So their debt ceiling is actually like, you know, kind of like how you set an alarm in TradingView. Like if I set an alarm up here and I add an alert, you know, then if and when we get to that level, I will get alerted, right? But the U.S., they set their debt ceiling very close to where the limit is currently, so that it deliberately gets hit very shortly, and then, you know, whoever's in power, whoever's not in power, the political party that's in the minority can then use that as a football for negotiations, right? It's kind of a very, very stupid system. That is what happens when you only have a two-party system like we have in the U.S. Other developed countries don't have that, and that's why they don't understand how we do politics and why we do politics like that. But yeah, Romy says our debt ceiling in the US is like saying hit me with 20 in blackjack. Yeah, dude, if you spend enough time at a blackjack table, you will come across a clown that either does that or splits his tens, right? Like that will happen, for sure. All right, chart the ES. Okay, I'll chart that now. NVIDIA. Okay, we'll do NVIDIA. We'll do ES. Oh, and by the way, one more thing. You guys might not know this. I'm doing a summer mentorship program, right? This was an idea that I came about due to a few messages that I've received about personal coaching and whatnot. I don't do one-on-ones. One, it's not worth my time. Two, it would be too expensive, honestly. So we are doing a mentorship. I'm going to be taking a max of 20 people. That's it, a max of 20 people, and we'll do you know, a whole summer program where I will coach this small group in terms of trading, in terms of charting, etc. And that way, because it is a very small group, every single question will be answered, and we'll make sure to get everyone's progress up to speed. It will be the second link in the description, I believe. So check the description, put your name on the wait list. Again, there will only be 20 people. You will get a what do you call it? An application back, and then if you are selected, you will know. So make sure to put your name on the wait list. As far as the program days go, it will likely be twice a week for 8 weeks. It will likely be towards the evening time here in the U.S., although we will play around with the times as needed for the group. And we are now ironing out the curriculum as well. So make sure that you put your name on the wait list below. All right, so you asked me to chart ES. Obviously, we were seeing a lot of wicks around the time that Jerome Powell started speaking, but really there wasn't much movement. I drew this level out here in the morning, but what really pushed us below the level here was when the debt ceiling talks were stalled. There isn't really much of an entry here for me, although I don't know if some of the other analysts or traders in the academy got in. But in terms of what I was seeing live, there wasn't much of an entry unless you just played the breakout, which I don't typically play the breakout, especially in this environment. I would much rather wait for a retest. ZT is climbing like crazy because of the debt ceiling stall. Remember how I was saying just before that debt ceiling news came out that the bond yields were going up because there was a little bit of complacency. And there was sort of a comforted atmosphere around the debt ceiling, right? Because on Tuesday they said that they would likely get to that it's very possible to get to a debt ceiling resolution by next week. Well, all that has gone out the window in 2 seconds, and now we are seeing a bounce in the 2-year yield. A drop in the 2-year yield and a bounce in the 2-year future. So I might re-enter this here today. And then someone asked for NVIDIA. NVIDIA has been the shorts killer, right? The absolute shorts killer. These are my levels on NVIDIA that I drew this morning that I put in the academy in the day trade section. As you can see here, I was watching NVIDIA, SPY, Triple Qs, AMD, and Netflix. But yeah, we crossed below that. There was potentially an entry here on NVIDIA for a short-term day trade. I was too busy covering the conference, but this would have been a likely short-term day trade here off of this imbalance. In terms of a daily chart for NVIDIA, there isn't anything to chart here, right? This is mostly, I would say, from the 230 level above is mostly a short squeeze. That's what this is. NVIDIA was one of the most shorted stocks, not only by retail, but also by institutions. And this is mostly a short squeeze coupled with AI enthusiasm. There isn't really much to chart here. I mean, we are near all-time highs, and we'll probably likely get there, right? Like, we're only a few percentage points away from that 340 level, and we'll likely probably get there. NVIDIA, in terms of valuation, yes, it's overvalued, but you can cry about that as much as you want. Tons of stocks are overvalued. It doesn't mean that it's unfair or it needs to come down. The stock market will pay what it wants for the stocks, and it doesn't really care about overvaluation. The stock market is all about FOMO. That's all it is, right? We're just a bunch of apes chasing price. No one cares about valuations, right? Just like you know, in the I don't know, in the Pokemon card craze or Beanie Baby craze or NFT craze, right? You can make a valuation, you know, a rough draft valuation of what those things cost. Like a Beanie Baby costs, I don't know, what, $15, $20? Why do some of them run for $1,500 or $2,000? It's because that, you know, the apes are chasing the price up. So same thing with NVIDIA. I do think we will hit all-time highs. We're not that far away from it. So it's not that crazy of a prediction there. But yeah, will you chart ZT looking at any point of entry? Yes, I'm going to likely enter ZT, and I will send the alert. I will send the alert in the academy. I will likely re-enter ZT. I did want to enter it this morning, but because I was stopped out already, I didn't want to get prematurely entered, so I wanted to wait for confirmation. This is a weekly imbalance here, a weekly fair value gap, and we did mitigate most of it. This would have been a solid entry, but again, this was one of the very few losing trades that I've had recently. You guys know I don't take a ton of trades. Quality over quantity for me, as always. And so, yeah, ZT, this trade here was one of the very few losing trades that I've had recently. All right. Is Jerome Powell still speaking? What are they talking about?
Accept that uncertainty and try and, do the best you can, being ready to adjust as new information arrives.
Very good. Thank you. We are getting close to the end of our allotted time. Maybe we could wrap up with just a question looking ahead. Jay, maybe we can start with you. What would you point to as some of the key issues that will be most relevant to the research community as well as to the policymaking community?
So I guess I would start with the labor market, and what we talked about earlier of vacancies in particular, and the beverage curve, and the whole discussion over whether the extraordinarily high level of surplus demand in the labor market can be lessened through the vacancies channel without a significant increase in unemployment. That would be more akin to what has happened in all prior cycles, or most prior cycles. So that's going to be a question that we will resolve empirically, but I think we're learning new things about the workings of the labor market, at least in this one situation. I think on monetary policy, it's going to be interesting to look back and try to understand how inflation spread from what was at the beginning, very focused on the goods sector due to the rotation of demand from services to goods, and the tremendous amount of support that goods purchases got from fiscal and monetary stimulus. How did it spread then through really into the service sector, where it now significantly resides? I think we're seeing much progress on goods, and we have progress in the pipeline on housing services, but where we see persistent inflation is now in the service sector. So what is the mechanism by which that happens, and what are the implications?
Ben, you have the last word.
Well, I think one of the things that difficult relationship. If you read the papers, you see that everybody has a very strong opinion about this subject, but they don't necessarily correlate. As Mark Twain once said, the things you don't know can hurt you as much as the things that you know for sure, but ain't so. I think that we really do not understand, to the extent that we need to, the relationship between different aspects of monetary policy, risk-taking, balance sheet behavior, et cetera. It's just something, there's a lot of good work being done, don't get me wrong, but I think we need to understand much better, what the channels are, and to quantify the relationship so that we can think about to what extent we need to take that into account in monetary policy.
Very good. Well, let me thank both of you.
Wow, like for real, they went all the way to Japan just for that? That's crazy. That's nuts. I mean, we didn't learn anything new, right? Curious if you have a separate dividend portfolio. I don't have a specific portfolio for dividends, and I hate this culture. Okay, let me tell you something that pisses me off, and I'm sorry if it's getting a little candid, but I just realized my knuckles are bruised as fuck. Damn, that was a tough boxing workout. I hate this culture of this online culture, right? Like on TikTok or Instagram or whatever, of gurus or financial gurus, right? Financial influencers showing people their dividend portfolio and saying, "Oh, I'm looking at this stock, and it's a stock that nobody's ever heard of," right? Say I just put $100,000 into this stock, or my dividend portfolio is paying me X amount of money a month. Dividends are not guaranteed, right? People talk about dividends like they're guaranteed. They talk about dividends as if it's something that's secured for life, right? And so you'll see a lot of these old, like if you go back and look at dividend portfolios on YouTube or Instagram, a lot of these stocks that people bought hoping for this large dividend, those dividends have either been cut or completely wiped out, right? Like a company's not obligated to give dividends, and a company can cut a dividend whenever it wants. A company can do away with its dividend whenever it wants. So buying, and I'm not saying, random card breaks. I'm not saying that you're advocating for this, but just buying random shitty stocks just for the dividend is not a thing, right? Like, it's not a sound investment strategy, right? Any monkey can look at a dividend yield and be like, oh wow, this is paying a 32% dividend yield. I'm going to click buy and buy 100,000 shares or whatever, and it's going to pay me, annual passive income. And then a month later, the fucking dividend goes out the window. So people think that dividends are somehow secure or that companies are obligated to pay dividends. A company can cut it whenever it wants. There's no legal obligation to pay dividends. A company only pays a dividend if it wants to reward investors and it has extra cash on hand and it wants to show investors that, hey, we're doing so well and we have all this cash on hand. Instead of doing buybacks, we'd rather issue a dividend and pay out our shareholders and thank them for holding shares of this company, right? Now, there are dividend aristocrats, dividend aristocrat stocks, right, that have paid dividends for decades, that are secure. You could just take a look at some of the dividend paying stocks in like Warren Buffett's portfolio. Those are not usually sexy to people because the dividend yields are paltry, right? You're talking about a 1%, 2%, 3% dividend yield. Instead, you have this culture on TikTok or IG of people buying, stocks that nobody's ever heard of because they're paying a 30% dividend yield. And, basically framing that as somehow it's passive income. No, you're going to get your fucking shorts lost when that stock doesn't exist in a year, or when it cuts its dividend, or when it completely pulls its dividend, right? So don't buy a stock just for the dividend. The first reason you should buy a stock is because, and I'm not talking about day trading or swing trading, I'm talking about investing. The first reason you should buy a stock is because you took a hard look at the company and you think that the price that you're paying for it is worth it for that company's growth, for that company's stability, or, for that company's value. That's the only reason you should buy a stock. If it pays a dividend, amazing. Now, you can find stocks that fit both descriptions, but it's usually not going to be the ones that are paying you a sexy ass dividend, okay? Hopefully that makes sense. All right, let's see. H Cupcake, appreciate your donation to St. Jude's. Thank you so much. Employment, Bradley Russell says, employment is still strong. Until the job market starts to get hit hard, we will have issues. I don't know what you mean by issues, Bradley. It depends on what you mean by issues. Richard, how do you get a TTT symbol next to your name? What do you mean? Me? Oh, the users? I think you just joined the channel on YouTube if you click like the join button on the bottom. All right, I missed out on most of the conversation. Well, good for you, Jason. You can rewind. When are you going to share your portfolio with us? You don't have to show the dollar amount. I mean, I haven't bought anything recent in a while, besides the purchases that I made in October, and then I recently bought some XLF as well. So Palantir gains 10 billion in market cap in one day because Cathie Wood buys 1 million shares. Not just Cathie Wood, because I think it came out a consecutive quarter of positive net income, I think. Do you think carry is an attractive long-term investment? Eventually, yes, I do think it is. What was the Netflix trade you were talking about? Netflix, I was waiting for this. Let's see if it hit. See, this is why you don't front run trades, right? Like I was going to buy puts at this GP earlier in the morning, and at this imbalance here, this box that I drew, and although we saw a small move down, those puts likely got killed in terms of value because it is options expiration day, and so you're technically trading 0 DTE puts. 0 days to expiration. So what I was hoping for was this. What I was hoping for was a move down and then a retracement back up, which is where I wanted to go short. And this, this move right here is essentially telling you that the market wants to break structure, right? That is why I was waiting for that move. that move did not happen yet, so I didn't take that. Market is crashing. No, stop being hyperbolic. The market is not crashing. I have the market right here. 0.17 down and on the S&P, 0.2 on the Nasdaq, 0.3 on the Dow Jones. Stop being hyperbolic. Joined late. Could you summarize, please? No. Rewind the tape. When are you going to... Oh, I already answered that. Do you like more growth or value? It's not a good versus evil conversation. If I see a company that I like, then I'll add it to the portfolio. Why is TLT moving higher when treasuries are going up? A lot of people, for some reason, don't know what TLT is, even though it's in the name. Look at the name of TLT. The specific name of TLT is iShares 20+ year Treasury bond ETF. And TLT is actually down today, but that's besides the fact. 20+ year Treasury bond ETF. So all of these bonds here, 1 month, 2 month, 3 month, 4 month, 6 month, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, has no bearing on TLT. It's in the name. 20+ year Treasury bond ETF. So you want to look at the 20 year and the 30 year. Both of those are up today. So TLT is slightly down today. Simple. And TLT is a horrible way to play policy events, right? You want to. That's why I always stick to the 2 year. The 2 year is the most sensitive to policy changes. TLT is too long term of a bond to be affected by policy changes, right? All right. Market tanking. No, not yet. It's slightly down. Tanking is like 1% plus down, right? And I'm not saying we can't get there. Especially after the market digests the news that the debt ceiling is completely stalled. Oh, actually, this is a interesting level to potentially short here. Ooh, this wick doesn't give me comfort because this is liquidity being taken. So generally, if you think of the market as every day is just a series of liquidity grabs, right? Liquidity grab from the top, liquidity grab from the bottom, back up top, back to the bottom. So this doesn't give me comfort, but if I combine it with price action, if I combine it with news, this is potentially a shortable level here. And my first target would be this, and my second target would be naturally this, right? And the reason that price stalled here is because we do have this consolidation from yesterday, right? It makes sense that the price would stall here a bit. Fuck, I really want to take the short from here. I kind of wish I kind of wish I grabbed. Now I'm looking at ES futures. I kind of wish I grabbed the top of this imbalance, right? Like around the 42.09 level. But 42.09 back down to 40. Oh my God, this would be. This would have been an optimal short, especially because, like, if we had shorted it from 42.09, my stop limit would be very close to here. Even though wicks are going crazy, but Jerome Powell is done talking. This would be the trade, which is almost a 7-to-1 trade. I might even, relent a bit on the profit taking just to include the bodies down here. Be a 5.5 to 1 short. Yeah, I don't mind this trade at all because the stop is 2.5 points, right? So the per contract, you're talking about $150 to gain 4209 to 4191. You're talking about an 18-point move? Yeah. Which is almost let's see, 1 point. Almost $1,000. I think it's $900. Yeah, but see, because my entry was late, like my entry would have been late, I wouldn't take it. And bouncing off this imbalance makes sense. Let me see where the fibs are. This was a good trade. Even if it doesn't end up working out, the RR is, I would take that RR every time. But I don't enter trades late, right? So like 4209 would be my entry because my stop would be super tight on this volatile day. Remember, options expiration day today is today. Monthly options expiration is today as well. But this already would have been a 6-point move. This would have already been $300 per contract, even if I just took profits here. But because I saw it late, I'm not going to enter at like 4207. Sometimes, man, I'm like, All right. Well, that was the fucking trade. After a day I had yesterday, I missed some good trades yesterday. It was still profitable, but I think I made like $400 yesterday. I posted it in the Discord. But that already, this is a 10 fucking point move. God damn it. I would have just closed it out. I would have been happy there. 150 to win 500. Oh my God, bro. All right. Roman, thank you so much for your donation. Appreciate you. Thanks for all the free money. Keep doing what you do. Did you take the short, Roman? Ay, ay, ay. Shorts at 42.15. Are you looking at ES or SPX, passport plates? Do you still like AMD? I don't know what that means. Do I still like AMD? Like in what sense? Sophia B, savage today. You talking about me? Oh my God, what a trade. I hope some of you took it. Are you Arab? What makes you say that, Kaleidoscope? I'm whatever you want me to be. I'm a racial chameleon. Alvin, as in the stock. Yeah, I know AMD's a stock, bro, but I don't know what he's talking about. Like investing at this price. Do I like their graphics cards? Do I like it for a short, a long? Do I like it for a day trade? You have to be more specific than that, bro. I know AMD's a stock, dude. Thank you for telling me AMD's a stock. Erish says, we all know Z's Mexican. Orale. We were following your scrolls until we were late to enter. We are following your scrolls until we are late to enter. I don't know what you mean. I saw GP. Well, yeah, passport plates. It depends on where you draw it from, right? Like, you could draw all kinds of fib levels. Like, there's a fib level that you could draw here. There's a fib level that you could draw from this top to this bottom, right? Like, the fib levels aren't singular. Wow, that would have been a 10-point fucking trade, bro. All right. Any stocks you find overvalued? Yeah, most of them are overvalued. What are these questions? Thought we were talking about a girl called AMD. Do you love AMD? Y'all are crazy, dude. Louis Silas says he's Native American. What tribe? What tribe do you think that is? Oh, man. All right, let me check on Netflix. Maybe I can catch something there. Because I've been staring at Netflix all day. Netflix doesn't want to play ball, bro. I thought Netflix was setting up for a nice flush after this run-up that it had yesterday and the run-up that it had today. I mean, not today, sorry. The run-up that it had yesterday and the run-up that it had 2 days ago. Let's check on Tesla real quick. And by the way, I'm going to teach you guys a trick in terms of how I look. Ooh, Tesla's setting up for a nice short. Yes and no. Yes and no. I'm not super confident about the short because we did, if you see this is what, I don't know. I guess some people will call this support. Some people will call this demand. Some people will call this liquidity zone. Either way, wicking into this liquidity zone here is not, this makes it a less viable short. If I did short it, it would only be for less, maybe like $1 or so until we got back to this level. But in this case, I would actually look more so for longs on Tesla. Plus, look at Tesla. Tesla is up 1.14%, right? The market is down 0.25%. So this is what I want to show you. When you are trying to decide whether to short or long something, okay? I want you to first take a look at its relative strength, okay? Or relative weakness. So what do I mean by this? If you take a look at this, right? So this right here is the S&P 500. If you take a look at this, the S&P 500 currently is what? The S&P 500 is currently red. So I want you to take a look, and the NASDAQ is too, right? The NASDAQ is even down slightly more. So I want you to take a look at companies in the NASDAQ, right? Let's just use the NASDAQ for an example because there's less stocks. It's easier to read on the chart, on the screen, I mean. So I want you to take a look at the NASDAQ, and I want you to take a look for stocks that are green, right? Now, you don't need Thinkorswim for this. You can use TradingView, but Thinkorswim is easier. If the NASDAQ is down and you have stocks that are hella green, like Adobe's up 1.67 today, Apple is up 0.26, not that much. Tesla's up 1.18. Cisco is up almost 2%. Intel is up 1.16. These are the stocks you don't want to short, okay? As a matter of fact, you likely want to look for longs on retracements, okay? This is called relative strength, relative weakness. 1 second. Yo, I'm gonna call you back, right? Okay. I'm just live. All right, bye. Sorry about that. So you want to look for stocks that have relative strength and relative weakness, right? So and the inverse is true, right? If the indices were green and you see stocks that are red, those stocks are, I'm not saying you automatically short those, but it helps you in your bias, right? So like looking at Tesla now, even though there was a potential short setup, I think that wicking into liquidity like this at support or at demand or whatever the hell term you use, and the fact that Tesla is actually up 1.25% while the market is down 1/3%, this would actually, if I don't long it, it would actually allow me to not short it, right? At minimum, I shouldn't be shorting this name. And at best, I might find I might find a long, although I might have missed the opportunity on the long, even though we didn't get into this imbalance here. But at best, it doesn't mean I automatically long it, but at best, I wouldn't short it. So hopefully that makes sense. Haider says, was that AMD calling? Man, I love some of the commentary on here. Yeah, AMD called me, bro. AMD called me. She canceled the date for tonight. Shafiq donated $20 to St. Jude's. Thank you so much, brother. Thank you. Appreciate you. Chief squats a lot. Who are we talking about? Maybe. Wait, he is Romani. Romani, like Gypsy Yanni? He said maybe, but he got some Cuban or Puerto Rican in him. Wouldn't short Tesla. Yeah, I wouldn't short Tesla. Alex Sanon says Z is Haitian. First time I got Haitian. First time I got Romani. Ecuador, got that a few. Albanian. Wow, that's I don't know if that's a good guess, bro. I don't know. My hair might be a bit too curly for Albanian. All right. Let's check on other trades. Let me check on ZT once again. We saw a pop. Now it's exactly flat on the day. Yeah, I might enter this. Here's what I'm looking at on ZT. This is more. ZT's really been one of the only things that I've swung it successfully 3 times. Lost on my last trade. If I do swing it again, it would need to be at least 2-to-1. Probably looking at something like this. This makes it about 2.25-to-1 trade on ZT. Somebody asked me if ZB was the same as ZT, and definitely no, definitely not the same. So ZB is a T-bond future, right? Now, people do use the term note, bill, and bond interchangeably, but they are not. They're very different. A bond is something that is 10 years plus. A bill, a T-bill, is something that is 1 month to 1 year, and a T-note is something that's 1 year to 10 years. I might be a little off on that, but essentially a T-bond future, these are long-term. These are long-term bonds, right? This is not the same as ZT. Why would they be the same but different? That's like saying, is AMD the same as NVIDIA? No, they're 2 different ticker symbols. So obviously ZT is not the same as ZB. But ZB tracks longer-term bonds, which is 10 years plus, and ZT is specifically only for the 2-year Treasury note. Z is Chinese. Wow, that's the closest guess ever. You guys hit it. I mean, you guys figured it out. Fuck. I'm outed now. I'm outed. Tesla. I told you, man, don't fucking short this shit. I told you this was a long, but it didn't get to my level. So I can't, I don't get mad about trades I would not have taken. I would not have taken Tesla because I likely would have wanted to long it from this imbalance. But yeah. Z is Ethiopian. No comment on that. No comment. He's half Japanese. He's Korean. All right. These are about as close as Chinese. Quarter Latino, quarter Mexican, quarter Persian, quarter Moroccan. That's a very, very specific and good guess. PayPal. What do you think about investing in PayPal what do you like about PayPal? Let me ask you this. Mick Milk says quarter black, some Latin, and slightly Middle Eastern. All right. Decent guess. Half Swedish. Are you saying that because of this? Are you saying that because of the Swedish flag on my hat? No, bro. This is a Swedish brand. I don't even know. Like, I saw the hat and I liked it, so I just picked it up. But no, I'm not Swedish. Good, you try to peep the flag on the hat and take a wild guess, but no, I'm not Swedish. All right. Is anybody trading anything today? Let's see. The VIX is up 4% today, I think. I mean, VIX has been super muted. But getting close to... Wait. This cannot be right. The VIX is not at fucking 19. Yeah, it's at 16. Okay, that was the VIX futures. Let's see. Let's take a look at Apple. Man, we dodged a bullet. For those of you that were in the Apple trade, let me peep it real quick. Closed the remaining half of the Apple Iron Condor for 69%. For those of you that were in the Apple Iron Condor, we dodged the bullet because Apple is that Iron Condor expired today. We closed it for 69% on Wednesday, and Apple since Wednesday is up to 175. That Iron Condor would have been worth $0 right now. So we got out just in time. That's why you don't fuck around and find out. If you're up 69% with 2 days left until expiration, you book that profit, right? I'm really trying to find a trade for you guys. I did find that ES trade for you earlier. Netflix is not budging, man. I can't, in good conscience, I cannot short this. I cannot front run this. And now we are hitting New York lunch session, so it is likely to get a little slower. Man, that was the primo freaking short on ES. We ended up getting to 41.97. Yo, that was a 12-point move, guys. That would have been the easiest short of the day. Could you short DNIYM? God, could you find a stock that has more letters in its ticker symbol? Went short on that drop Z. On which? On the S&P 500? Why spy with how dovish Powell sounded at the end? Not sure what you're asking, Miggy. Suresh says Palestinian and Egyptian. Good guess. Looking to get back into ZT? Yes, I talked about it like for half an hour. Scottish Indian? No. Although Scotland has the best Indian food, hands down. And I ate at the restaurant in Glasgow that has the claim to fame on chicken tikka masala, right? Chicken tikka masala was not created in India. The specific dish, obviously masala, tikka, all that is Indian. But the specific dish that is now the national dish of Britain was created in Britain by immigrants. And the first restaurant that lays claim to that recipe is in Glasgow. And now, obviously, there's a lot of restaurants in the UK that will lay claim to that. But there's one in Glasgow, and I ate there. All countries have better food than U.S. I would beg to differ, actually. I would beg to differ by a mile. And trust me, I've traveled a lot. I think the U.S. has the best Mexican food. I think the U.S. has probably the second best sushi. Next to Japan. I think U.S. has probably the second best Italian food, next to Italy. I think the U.S. has the second best Korean food by a mile. I think the U.S. has the second best Persian food. So I really beg to differ in terms of the U.S. having bad food. I think the U.S. is top notch in terms of food. And obviously it's due to the large immigrant populations that we have here. But no, I mean, the U.S. has way better food than places like Portugal, way better food than places like the UK by a mile, way better food than the Nordic countries. Nah, dude, the U.S. has fucking amazing food. What are you talking about? And yeah, the second best Cuban food to Cuba. Have you been to Miami? San Diego has the best Mexican food. Yeah, I'm not going to argue with you there. It's a toss-up between San Diego and L.A. You're fucking tripping if you think the U.S. has bad food. The U.S. has amazing food. Now, if you're talking about like what is culturally American, like a cuisine that Americans came up with without the influx of non-European immigrants, yeah, I mean, of course, but the U.S. is a country of immigrants. So, have you tried Southeast Asian food? Yes. Singaporean food, Indonesian food, Thai food, obviously, Vietnamese food. Yeah, we have a ton of those enclaves here in California. Best soul food, hands down. Yes, and I would say LA's underrated for soul food. For sure. I mean, obviously you have states like Georgia and Alabama, but I think that LA is underrated for soul food for sure. What's the best sushi spot near LA at a good cost? I would say Sugarfish. Sugarfish is really, 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 really good and a very decent cost. Like the same type of sushi in New York, especially if you get like omakase style, where the chef picks the sushi for you, that'll probably run you like $300 per person in New York. And in LA for two people at Sugarfish, you could probably get out with about $120, including a bottle of sake. So yeah, but you're tripping if you think the U.S. has bad food. Henry, is this a food channel? It's an everything channel, dude. We talk about everything. Yeah, I'm about to give up on the. I mean, it is lunch hour in New York, so we will likely see more action thereafter. Like if you look at the Nasdaq, the S&P, they're both pretty much stalled at minus 0.15%, minus 0.18%. Sugarfish is not Swedish, bro. The chef is called Nozawa. Nozawa does not sound Swedish. He's from Japan. Oh, by the way, is anybody on here from Japan? Is anybody on this stream from Japan? Let me know. There's a specific reason I'm asking. And if you say yes, then I will tell you. Today was a paper trade day for me. Yeah, Dina. What's going on, Dina? Yeah, I mean, honestly, that was for me, that trade setup that I highlighted earlier, was the only A+ trade. Low Key the Great. Are you in Japan or are you in the US? Or are you familiar with Japan? Reason I'm asking, Dilwar Singh. Bro, you're fucking tripping. With a name like Dilawar Singh, you are not from fucking Japan, bro. Plus, you got your profile picture in your little avatar there. Dilawar Singh sounds like a fucking Bollywood superstar. All right, Kinan. All right, man. I mean, Kinan. Obviously, unfair advantage that I fucking know what you look like. All right. Dillo. Ramo 86 says Dilawar identifies as Japanese. All right, guys. I'm gonna be in Japan next week. I'm gonna be in Tokyo, Kyoto, probably Nara. If you guys are in Japan, let me know. Hit me up on IG, actually. If you guys are in Japan and you want to meet up, hit me up on IG. And you better not disappoint me in terms of food or drink recommendations. Okay, Oxy. Let's look at Oxy. I was looking at Oxy's level only because energy was getting surprisingly low. Not only, oh, by the way, we did have a short also on CL futures on the on crude oil futures. So looking to get back into crude oil as well. That was we netted about $500 a contract on that. But Oxy, I do like it here. You know, I would probably opt for selling puts on Oxy rather than buying the stock. And then you can run the wheel strategy. So I would opt for, let me look at Oxy's chain here. So I would opt for maybe going out to August. I mean, the put premiums are not great, and it's probably because its IV is super low. Yeah, Oxy's IV percentile is fucking 1%. So super low IV right now, which is why you're not getting a ton on the premiums. Maybe I would opt for, I mean, that's a May, June, July, August, September. That's 4 months away. Selling the 57.5 puts for 350 would get you Oxy, at what, $54? And it's currently trading at 59. So I would likely sell the 57.5 puts expiring in September on Oxy. I do like Oxy here. Plus, it does pay a pretty nice dividend, not crazy like some of the other dividend crap stocks that people go for, but it does pay a nice dividend. And I think Buffett owns like a quarter of the company, if I'm not mistaken. But yeah, I would I wouldn't mind Oxy here, honestly. And if we take a look at petroleum, I shorted. It was just a day trade, but I shorted petroleum. Could have held that short for more. I exited at like 72.40. And now crude oil is trading at like 71.5. But yeah, I mean, we're seeing levels on petroleum that we saw back in 2021. And then also pre-pandemic, right? This is like 2019 levels that oil is at currently. So I don't mind some energy stocks here. If we take a look at XLE, XLE looks, this looks like a point at which I would dollar cost average in XLE, honestly. Already started dollar cost averaging in XLF when we hit this support level here. And XLF, I think there is a lot of upside for the very long term. This is not a short-term play, but yeah. All right. Muhammad Malik says, from my analysis, AMD seems to have broken resistance on the daily. Do you see more upside? AMD is not as sexy as NVIDIA in terms of AI, but this is not the place that I would buy AMD because, I mean, like you said, well, you didn't say this. You actually said it broke to the upside, but we are at the same July 2022 resistance. So I'm not looking to buy AMD at 106, honestly. In terms of what it will do, it really depends on, it really depends on the AI sector, honestly. I don't think it can run to and blow past this level just based on, legacy business models. It has to interest the market more as it relates to AI. But I will likely be sending out a play on ZT later today. I do like this 2.25 to 1 trade here. I will potentially enter a trade on ZT, especially as the debt ceiling talks continue to stall. June 1st is the deadline for that. Again, make sure that you sign up for the waitlist here. I'm going to be mentoring a max of 20 people in the summer. And if you want to get on that very short list, make sure that you use the second link in the description. Put your name on the wait list. Also, monthlies are back. So that is probably the first link in the description. You guys asked for monthlies. Those are back. Make sure to sign up for the basic membership to the Academy. But yeah, that great short could have been done twice. Double top on the 1 minute, Dina says. Are you talking about on ES? Let's check it out. Yeah, I mean, that short was money, Dina. That was right on the money. And would have gotten to my ultimate PT here that I drew with this tool, with the profit tool here at 41.95. That was the ultimate short. Hopefully some of you guys took it. That was the play of the day. Once again, another play called out live. But yeah, that you would have not had to trade anything else. That's a one and done trade right there. Radical theology. What about NVIDIA? I talked about it already. Is there a micro version of ZT? Ophir asks. Very good question. No, there isn't. Sony says, I made 11% on it. Good job. Do you have to be a member for the mentorship? No, but it's not free, obviously. So you will get the details in the email. But no, you don't have to be a member. Rebbe says, thank you. I made 25%. Appreciate you, men or women. But yeah, that was the play of the day. What the fuck? Another one called out live. I think we are, I want to say 100% on plays called out live this year. I don't know. I don't remember calling out a play live or taking a trade live that didn't work out this entire year. Obviously, I'm not taking a zillion trades. It's usually one thing that I'm looking at per live session. But yeah, and now we're forming this H pattern here. I am potentially looking for more lows here on the S&P 500, especially as lunchtime nears its end in half an hour. So, well, there it is. Guys, make sure you sign up for the monthlies. That link is in the description. Hit that thumbs up on your way out so that more people find this after the stream is done. What about TLT? Ash says, I talked about TLT already. I don't like TLT. I don't care for long-term treasury ETFs. I'm not sure what the obsession is with TLT. I like trading short-term treasuries better because they are more policy sensitive. Played a nice bull on ZT today. You introduced me to ZT. Thanks. Wow, amazing. Good job. Hugh G reaction. Any fees on TOS for holding ZT futures for multiple days? No, you don't. You don't get fees for holding futures. You get fees just for entering and exiting. Richard Soren, thank you, Z. Have a beautiful weekend. Appreciate you. Keith Miller identifies Palestinian and Z is my cousin. Netflix Flush will come Monday. Maybe. I will be on the lookout because it definitely has a nice setup. Congrats to those that took this ES trade here. Hit that thumbs up on your way out. Check out the monthlies below. Sign up if you want to be on the wait list for that summer mentorship program. Appreciate all of you guys. Have a great weekend, and thank you for hanging out with me today. Peace.